Start your day with It's the Business. Here's Phil Dobbie.
So yesterday was Budget Day.
This budget meets the moment with a three-part plan to protect the jobs and livelihoods of the British people.
And the first of those three was getting people through the continued lockdown and out the other side, hopefully with a job intact. The second one, well, that was the bad news.
And given how high our debt now is, we need to pay close attention to its affordability.
Although, to be honest, there weren't too many government cutbacks or tax increases, except freezing the thresholds on income tax until 2026, which is really a tax rise driven by inflation, and it is going to progressively hurt the poor more than the rich. But hey, it is a Conservative government, I suppose. And increasing capital gains tax, that's not going to be introduced until 2023. And then there's stage 3, building back better.
As the economy begins to recover, we are shifting our resources and focus towards getting people into decent, well-paid jobs.
This morning we'll look at the budget yesterday, the good, the bad and the downright bizarre.
So I'm announcing today a new policy to stand behind home buyers.
And he's going to do that by helping to push prices up. To help us analyse it all, economist John Ashcroft joins me for this budget special.
It's a question of how quickly things return. The debate's going to be about now how quickly things will return to normal, or some semblance of normality, after the lockdown is really unwinding by the end of June, let's say, May, June.
Well, we'll see, won't we? It's Thursday, the 4th of March, 2021. Good morning.
And now, it's the business, making sense of it all with Phil Dobbie.
Well, those rising taxes, they are the focus of the morning's newspapers today. The Eye, Budget 2021, highest taxes since 1960s. The Times, highest tax levels for 50 years, an additional £70 billion from increases and freezes. The Daily Mail, Rishi's masked tax raid. The Daily Telegraph, Sunak's 5-year tax grab. The Guardian, spend now, pay later. Sunak flags major tax rises as COVID bill soars. And the FT, Sunak reveals spend now, tax later plan. And the curious thing about the tax rises, a chunk of it is going to come from capital gains, from taking it from 19% to 25% by 2025, even though we've previously been told that capital gains was to keep businesses operating in the UK, to make it attractive to work here. Where were we wrong on that? Why is it now okay to go back to 25%? If it's always been the case, then how much less austerity could we have had in the last decade? I wonder how many people are going to be asking that question soon. And also, I wonder how many people are going to be asking, how will a government that's promising to level up the economy fare at the next election, when low-income earners figure out that the tax-free proportion of their income is gradually being eroded year by year for the next 5 years, and how pronounced it is going to be obviously depends on the rate of inflation. But Rishi Sunak still saying he's going to do whatever it takes to get through, even with over 700,000 people losing their jobs, a 10% fall in the size of the economy this last year, and the highest borrowing outside of wartime, that's pretty much how he set the scene. Lunchtime yesterday, but you've got to sell it bad to say how you're going to fix it. There are 3 parts to his budget, he said: continuing doing whatever it takes to support people and businesses through the crisis, then fixing the public finances, and third, building the future economy. Well, let's go through those with economist John Ashcroft. Now, John publishes a very useful economic review each week called the Saturday Economist, and he's known as the Saturday. He works during the week as well, but worth looking out for what he does each Saturday. And I wanted to get him on. I want to get you on, John, because I've wondered how much levelling up there was going to be in this budget. And you are based in the north. Shame you're actually not in the northeast, because the northeast seems to be doing rather well. Maybe it's because it's close to Rishi Sunak's constituency, which is Richmond in North Yorkshire. So not far from there, you've got the free ports in Teesside. You've got port upgrades in Teesside as well for shipping out wind farms. They're going to put money into that. And the new campus for the Treasury is going to be in Darlington, just a short drive away from Richmond as well. And not far from Barnard Castle either, if you need to get your eyesights tested. So it is all going on up there, isn't it?
They've got the infrastructure bank in Leeds, and they've got a free port in Liverpool. So I'm based in Manchester, so we're sort of sulking a bit in Manchester.
Yeah,
well,
exactly.
It wasn't nothing much mentioned today, but I'm sure there must be some goodies coming our way.
Well, maybe you need to get a Lord Mayor who's a bit more amenable to the incumbent party. Perhaps maybe he's created too many problems. But do you think generally it's been a good budget?
I think we styled it very much as a sort of, was it going to be a budget for recovery or a budget to balance the books? And there's no doubt about it, this is a budget that continues to sustain the recovery through 2021.
Yeah.
And realistically, he's got... Well, I'm not just kicking the can, it's providing support while the businesses return to life. He got a little option basically given that there was sort of like 4.7 million still on the furlough scheme at the end of January.
Yeah.
So to get them back into work, it gives us time to see how things can unwind as the lockdown eases.
So I was a bit curious. The OBR, he said, is now forecasting a swifter recovery than they were expecting in November, even though the situation has got somewhat worse since November. Let's just play a quick grab from Rishi yesterday. This is Rishi Sunak with his forecast for the speed of economic recovery.
The OBR forecast that our economy will grow this year by 4%, by 7.3% in 2022, then 1.7, 1.6 and 1.7% in the last 3 years of the forecast.
So he says by the OBR forecast, the economy will return to pre-COVID level by the middle of next year, 6 months earlier than previously thought, although will it? I mean, they've drawn that conclusion, but they've also downgraded this year's forecast, haven't they, from 5.5% to 4%. So they're expecting a big make-up next year is going to happen.
Well, it's actually a phasing issue, really, because the Bank of England only last month were forecasting growth of 5% this year. And the National Institute were more pessimistic. They were talking about 3.5%. But actually, having looked at the lockdown figures and using our own GDPO output model, then you could see growth of 6.5% this year. So we had 6.5 in this year as a bullish extreme, slowing to 4 or 4.5 next year, which actually is 11 points over 2 years. And if you do the arithmetic within the OBR, 4% this year and 7% plus next, it's the same. So it's a question of phasing. I think the OBR have been more cautious about the return to the easing of lockdown and the return to full capacity in certain sectors. But actually the prospects look pretty good for this year.
So a lot better than the IMF is forecasting. Now, I don't know what you think about IMF forecasts, whether they're actually useful or not, but I mean, they're saying 5% for next year versus the OBR saying 7.3%. I mean, I might not be comparing like for like, but the IMF is saying...
But the OBR this year, the IMF this year is saying 4.5. So, they're slightly more bullish about this year and not as bullish, obviously. So I don't think you should get too excited at the moment by the OBR forecast, because over the 2 years, we've been more or less in the same camp. And it's a question of how quickly things return. The debate's going to be about now how quickly things will return to normal or some semblance of normality after the lockdown is really unwinding by the end of June, let's say, May, June.
And is it going to be a bit of a race? I mean, if you are the economy that kicks back the fastest, I mean, we have certainly gone in deeper than practically everybody. If you come out the fastest, are you going to get some sort of competitive edge, or doesn't it work that way?
I don't think it works that way. We're not really in a race. I mean, I think it's a miracle, if you think about it, that we've had a 10% shock to output last year, which could have seen unemployment rising by 3.5 million, realistically. And it's the actions of the Treasury, specifically through the furlough scheme, that's made sure that did not happen. And now, with nearly 5 million on the furlough scheme at the end of January, the Treasury were terribly worried that would tumble out too soon and it would tumble into the unemployment lists. So as it is, unemployment's going to peak, we think now, about 6.5% in the third quarter. But that's still a remarkable achievement, given this incredible shock to activity that we've seen.
Yeah, and bear in mind this week they were forecasting 11.9%, weren't they, early on? So
yeah, they were. Yeah, but I think again they've been slightly taken by surprise at how quick the furlough scheme has been taken up and how far it's been extended. Because at that stage, the plans were not to extend it even to April. Yeah. So the extension of the furlough scheme mitigates the return.
Yeah, it does, and it's continuing until September. So they've sort of learnt from the mistake, haven't they, from last year? If you pull it back too early, you're going to see jobs disappear if businesses haven't got a clear view about how they're going to pick up and start trading again.
Well, you see, I'm more generous than you, Phil. I would say that basically they didn't make a mistake, but they didn't know they were going back into lockdown in November, and they certainly didn't know they were going back into lockdown for 3 months in the first quarter of this year. So it's a question of flexing that, giving that flexibility to the furlough scheme, which is quite a remarkable thing to have done.
So not a lot for the self-employed in all of this. They have extended their support alongside furlough for people who are sole traders. You've got those people who've been saying, look, we've been excluded, and we were talking about it on the podcast yesterday, the company directors who are pulling out dividends, who've basically had nothing all the way along, still nothing. Company directors could still be struggling right through till this is all over.
Well, the critical thing is to make sure that the return out of lockdown, the release scheme, does take place, and we see this gradual recovery in the economy. Because what we've not seen before is this restriction to output as a means of compressing the economy. So it's a bit like we said, you apply these medieval measures of containment for the plague with a full shutdown, like staying behind doors with a red cross on the door, that if you apply these medieval measures of containment to a contemporary economy, then you're going to drive us all back to the Dark Ages. But what we have seen is, the measures have been effective. Output within the economy, especially in the accommodation and food sector, is going to be released. And therefore, you'll see a big, swift return to activity this year. And the OBR are more pessimistic about this year over next. But given, the Bank of England reckon that consumers, households are in reasonably good shape. Investment within business is going to be high, given the generous allowances released today. So I think that you'll see this return to activity, which is going to take many people by surprise.
Right. Well, let's hope you're right. I'm a little bit more sceptical than you, but look, we'll wait and see. But a big chunk of it was, and I guess we the question is, why did we have to wait for today? A lot of it is just, we need to continue. We need to keep carrying people over that bridge. So we've stalled an end to furlough. We've stalled the reintroduction of business rates for a few months. We've stalled the end to stamp duty. We're freezing duties on fuel and alcohol. We're keeping tax brackets as they are. We're extending the £20 universal credit. There's a theme here, isn't it? Let's just carry on doing what we're doing. Extend the 5% VAT for hospitality and tourism till September. Then they're going to raise it to 12.5% till April next year. It's all fair enough, but it seems like the major items in the budget, the ones that are going to have the most impact, are the ones that are just saying, yes, let's just keep doing what we've been doing throughout this pandemic until it's all over.
Yes, because the major priority is 5 million people under these artificial employment schemes with the furlough scheme. They can't risk that tumbling into unemployment, because that would be both politically and financially unacceptable. So they have to continue to support the recovery and not balance the books.
How many of those 5 million jobs, I wonder, are real jobs, though? We might be propping them up, but when we come to the end of the furlough scheme, a lot of those jobs might just disappear, because we've got no idea how many of them are real jobs, do we?
We do. We have a pretty good idea, because in September and October, the number of people on furlough dropped to about 2.5 million. So it was when it went into the November lockdown that it started to rise again, and then kicked off again in January with the third lockdown. And we can know which sectors they're in as well. So we would see that fall as the economy opens up towards 2 million anyway. And we know which sectors have been badly hit. So we know accommodation and food, over 1 million, retail and distribution, over 1 million people on the furlough scheme, construction and manufacturing, 500,000. So we know that those sectors, like manufacturing, is bouncing back well, construction's bouncing back well. People will go out to eat, and they'll go out to the staycation market will be good. So the big question is about the future of some of those retail jobs, when we've seen so many go online and into internet trade. So that's the sector that one would be more worried about than others. But generally, if it fell to 2.5 million on furlough in September, October, it will fall to 2.5 million and lower by the end of September. And in addition, the real structural challenge will be what's going to happen in retail.
Right. And what about real estate? We seem to have this fixation with real estate. And I know economists love real estate because it's a contributor to GDP, but really, does it do much for the real economy? Rishi Sunak announced that the stamp duty holiday is going to continue till the 30th of June. A question, was it really needed in the first place? Would house prices come and go? But they've been holding up pretty well. The threshold is going to be reduced till September after the 30th of June. But more importantly, he told us this yesterday.
Even with the stamp duty cut, there is still a significant barrier to people getting on the housing ladder: the cost of a deposit. So I'm announcing today a new policy to stand behind home buyers, a mortgage guarantee. Lenders who provide mortgages to home buyers who can only afford a 5% deposit will benefit from a government guarantee on those mortgages. And I'm pleased to say that several of the country's largest lenders, including Lloyds, NatWest, Santander, Barclays and HSBC, will be offering these 95% mortgages from next month.
Well, they would, of course, wouldn't they, get behind it if the government is going to underwrite it, mate? But, because it seems like a safe bet, probably a safer bet than an unguaranteed 90% mortgage. But what haven't we learnt from this? It's just going to put the price of houses up, isn't it? So the young people who have got their money that they're ploughing into this are going to be left with bigger debt. And if it boosts house prices temporarily at that lower end, then prices start to fall again once this scheme's removed. Then they could face negative equity as well. So it raises the question again: is buying a house really a priority right now? Should we be using government money in this way?
Well, I think this is where you begin to question some aspects of the policy, because you're quite right. The measures that pushed up house prices or helped to push up house prices, this era of low interest rates, together with the housing concessions on stamp duty, meant that even with rising unemployment, we saw house prices averaging 7% in the last quarter of the year. So I think it is correct that some of these concessions are going to push up house prices. And I think that if the stamp duty scheme had been terminated or ended at the end of March into April, then that may have been a better thing than not. So I think there were too worried at the moment about house prices falling, because there is so much liquidity in the system and interest rates still remain quite low. So house falls are not the issue. But the argument here is very much quite local or political and social rather than economic, because the economic arguments would not argue in favour of an extension of stamp duty beyond April.
Yeah, or getting people to take out 95% mortgages. So Keir Starmer naturally responded to this. He said, look, we've lost almost 250,000 council homes since 2010. If we want to help the construction sector, just build more council houses, and that will address housing affordability. It will bring down house prices for everybody. We'll feel a little less rich as a result of it, but it will help kids buy houses.
Yeah, well, I'm sure that I wouldn't want to pick on a bench argument with Keir Starmer, but yeah. I think you're getting into difficulty when you get into the whole housing issue, really. But I think the second area is where the OBR were very generous in the treatment is when these measures to so-called balance the books, the freeze on personal allowances and the increase in corporation tax. The OBR are extremely generous because all of those measures don't kick in for 2 years. So yes. What you got effectively
that was a big surprise, wasn't it? Because there was that. I mean, two things that we were looking out for today. One was that where we're going to have corporate tax increased in the short term, and the other one, no mention of IR35 as well. The idea that we're going to level out the people working for themselves and their national insurance contributions.
Yeah, well, that's too technical for the moment. But I think that the fact that the OBR were very generous in terms of the numbers. That the borrowing figures this year are going to be 350 billion. There's a question mark there over what provisions have been made against some of the loan schemes, because they were in the earlier OBR forecasts. But anyway, 350 billion this year and 240 billion next. Those are huge numbers. And after that, it all comes blissfully floating down quite nicely, mainly because, you've got these tax hikes coming in. But you've still got to wait 2 years. And there's a lot of spending to be done and is being done between till we get to those sort of high zones of higher corporation tax.
Well, let's go back to Rishi and hear what he's got to say about, just the amount of money that is being borrowed right now.
The OBR's fiscal forecasts show that this year we have borrowed a record amount, £355 billion. That's 17% of our national income, the highest level of borrowing since World War II. Next year, as we continue our unprecedented response to this crisis, borrowing is forecast to be £234 billion, 10.3% of GDP, an amount so large it has only one rival in recent history, this year. Without corrective action, borrowing would continue at very high levels, leaving underlying debt rising indefinitely. Instead, because of the steps I am taking today, borrowing falls to 4.5% of GDP in 22-23, 3.5% in 23-24, then 2.9% and 2.8% in the following 2 years. And while underlying debt rises from 88.8% of GDP this year to 93.8% next year, it then peaks at 97.1% in 23-24, before stabilising and falling slightly to 97% and 96.8% in the final 2 years of the forecast.
Well, I tell you what, if he can achieve that, he's going to achieve something that a government hasn't done this century, isn't it? I mean, here we are recovering from the worst crisis we've seen since the Second World War. And he's reckoning that in just a handful of years, we are actually going to see that government spending is going to start declining. Is that really achievable, do you think?
Well, I'd never place much store on any of the OBR forecasts beyond year 2, really. But you got the numbers sort of say, 355 billion borrowing this year, 234 next year. Then it falls to 107 billion miraculously in 22, 23, and then down to 73 billion, 75 billion by 25-6. That's going to be extremely difficult. And it's largely because they've, so the giveaway this year is worth 50 billion. So the very fiscally extensive budget for this year, which is a good thing to support the economy. But thereafter, they've penciled in some reasonable returns for corporation tax and income tax. And we'll see if that happens. But
so corporate is the interesting thing. I thought we cut corporate tax because it was a disincentive for people establishing businesses in this country. Now that doesn't seem to be a problem. What's happened? What's changed?
Oh, well, you see, this is, if you watch this idea that we're going to become the Singapore of Europe was dismissed in my blog a couple of weeks ago as just Fantasy Island with a nice picture of Rishi Sunak in the process. But the idea of reducing tax rates to 17% has gone out the window totally, and now we're going completely hurtling the other way towards 25%. So it must be confusing. But there have been some generous accommodations for smaller businesses. And this huge, very generous tax allowance scheme is in this super allowance scheme for the next 2 years, which is like if you invest and you get 130% kickback on the investment as a tax relief. And that actually,
I was listening to that thinking, what can I buy? It was, I'm sure lots of businesses.
Well, you get a new computer.
But is this being tried? I mean, he said it's not been tried anywhere in the world. I mean, it does seem like it. I mean, it'll be an interesting experiment to see whether it does work.
It will. And the OBR have penciled in 25 billion in terms of the cost to Treasury as a result of it. So that's 12.5 billion effectively over this year and next year, which sort of wipes out the gains they're going to get from corporation tax over the following 2 years anyway. So, some interesting thought process there.
Are they hoping that money is going to be spent in a way that's going to increase productivity, or is it just going to increase expenditure? What's the upshot from it?
Well, I don't think they define the quality of investment they're going to get, but what they want to see is a stimulus to investment. And again, that's where the OBR slightly vary from we would be at, because they're assuming that the bounce back in investment and in consumer spending, for that matter, will largely occur in 2022 next year and not this year.
Is that money well spent, do you think, on this capital allowances?
It is ironic that this hike in corporations tax, which is going to save the balance sheet, has actually been spent in the prior 2 years on capital allowances. So we'll see what happens with that.
We will. All right. Well, and look, the reason why he was making that point about, we have to be a bit more sustainable in the way we manage our finances is because he's got this worry about rising interest rates. I mean, maybe in a few years that will be a problem. But I mean, if the government's issuing a lot of long-term bonds, 30-year bonds, for example, at virtually close to zero interest rate, they're going to be largely dissolved by inflation over that 30 years. So is he? I mean, and I know that they're issuing shorter-term bonds. We can't issue everything for 30 years, otherwise we'd just say, well, let's call it a 100-year bond and put it all in that. But is he painting an overly bleak picture? Do you think? Because I mean, the interest rates are low, and if inflation kicks back in, and that could be a good thing if the government's got so much debt.
Well, I think step by step we get there. The level of borrowing, or the level of total debt, increases to 2.8 trillion at the peak of this cycle. So, in principle, then, a 1% increase, which is what they talk about, a 1% increase in interest rates could lead to a 23 billion increase in the interest charges or the yield charges. But actually, that's not quite correct, because we have this wonderful scheme. We call it dire straits economics, where it's money for nothing, gilts for free, where the Bank of England are buying 40% of the gilts. And that money is paid back to Treasury anyway. So the full coupon charge is never 23 billion on 1%, because almost half of it is kicked back to Treasury. The money is paid by the debt management. So the debt management office issue the gilts. The Bank of England buy them, underwritten by Treasury. And then some bright spark in the Treasury realised that, those interest payments, those yield payments, are actually ours. So we should just get them back.
Yeah.
So it's not 23 billion anyway. It's far less than that. And again, the other thing is that effectively, what we talk about here is that the liability within Treasury is an asset owned by the Bank of England, and both of which are owned by government.
Yeah.
So we don't have to worry so much about this level of repayment. Like old soldiers, it can just fade away.
Yeah,
just a bit of intergroup consolidation, it can be written off.
Yeah, exactly. Well, and just reissue it again. But I mean, my point was, if they issue bonds and it does get passed onto the open market, and someone else buys them, and they're bought for a lot less, so the yield is a lot higher. It doesn't really matter to the Treasury, because the Treasury issued them at one point. They're just paying the coupon based on what the interest rate was at the point they issued it. I mean,
yeah,
it becomes an issue. Becomes an issue when they have to buy them again, if we have to refinance, which obviously there's a lot of that's going to be going on for the next decade or so.
Yeah, I think, yes, you are quite right in that sense. But it's a question of the maturities. So if you think that the funding requirement this year is going to be over, so the debt issuance, like renewals of something like 100 billion last year. So that's a question of dating it. So as inflation rises or as interest rates rise, then you have to issue new with a higher coupon. But it's never, as you're saying, it's never the full 100% of the average 2.3 billion over the timescale they're talking about now. It's not that anyway, because it's nearly half of it's owned by the Bank of England.
Exactly, and they can always buy more, of course. Now, this third stage, which they probably will, building the future economy, that was the third stage. So retail savings bonds, free ports, including that one in Teesside, new port infrastructure, green technology. Those retail savings bonds were there to support green technology. Moving the Treasury to Darlington. I mean, so look, free ports. Are you a fan of free ports? I just wonder, in this digital age, whether it's a bit of a manufacturing-based idea, but also, what are we going to do in them? Are we going to add enough value during the process? If we ship something into Teesside, add some value to it somehow, and then think we're going to export it to Europe, we'd have to change that product quite a lot if we're going to avoid paying tariffs to get it into Europe. What are we going to do in these free ports?
Well, if you do that, you probably fall foul of the rules of origin anyway. So, in fact, if
that's what I mean.
So I'm a bit like you. I'm sceptical about the value of free ports, but there'll be a stimulus to construction and investment in the local areas. But whether the overall value to the economy is somewhat more circumspect, I think, really. But we didn't hear a lot about the building for recovery. It was all about sustaining the recovery, and which was like 80% of the talk, and then balancing the books worth about 10%, and maybe 5% about the building for recovery.
Yeah, well, yeah, exactly.
A few wind farms and
which is fine. And the helping to transform businesses with the Help to Grow scheme, which I thought was interesting. And I looked into it. That's 30,000 places over 3 years, 90% subsidised by the government. The participants pay £750. They go on a 12-week programme delivered by a business school somewhere. That's something else I'm pretty sceptical about. I'm not sure that's going to transform the world of business. But we do need to, obviously, and this is the stuff that we're not hearing, we do need to look at how the economy transforms for a digital age. Maybe a lot of us have picked up a lot more of it because we've all been Zooming like there's no tomorrow. But as you're saying, he did say it was a three-pronged attack, but the third one was sadly lacking, wasn't it, really?
Yeah, and there's no talk about the especially on telecommunications with 5G. So, looking recently at last week at the sort of investment plans for China, where they're planning to double the size of the economy by 2035. You're talking about 70,000 kilometers of high-speed rail, and they want to become leaders in robotics and semiconductors and artificial intelligence. So that sort of agenda didn't sort of feature in the shopping list for Rishi Sunak at all today.
Well, that's a great segue, because we're talking about that on the programme tomorrow, about how not 5G necessarily, but getting broadband faster into more homes, which I think we've all seen how bad it is, haven't we? We've seen so many TV and radio interviews with shaky pictures. We need to get our broadband ready for the next time this happens. But the other things Keir Starmer was saying there was no mention of Brexit and the need to reduce red tape, helping the fishing industry and helping performers who want to go across to Europe. Nothing about the Northern Ireland Protocol and all the border controls that are needed there. Nothing on social care or inequality. He said, we're going to be left with businesses struggling to pay back money they never wanted to borrow. Really, he was just papering over the cracks rather than rebuilding the foundations. But I think Keir Starmer was thinking on his feet a little bit. I don't think he got the detail in advance, so perhaps he didn't put across the most convincing argument. But a few good points in there. I mean, we've forgotten all about Brexit, haven't we? And yet that is probably one of the biggest problems we're going to face. And we certainly would be focusing a lot on it if we didn't have this pandemic.
Yeah, well, I think that, the Brexit issue continues, and it's a frustration for many, and many are having to reconsider their commitment to Europe, or certainly the commitment to a UK base. So if you want to cross-trade, then you've got to cross the channel and set up a local company to assist with the administration. Some of that stuff is really, archaic. That a lot of the paperwork involved now should have moved to digital. And some of it's more sort of strategic, with the Bank of England at the moment getting very upset about some of the poaching that's going on in London. So you have to break it down. For most people, on either side of the channel, they have a self-interest. Businesses have a self-interest in making sure a lot of these issues relating to paperwork or the inspection regimes should be, come to some kind of normality over the next 3 to 6 months. One would hope so. But nevertheless, well, don't get me started on Brexit. We haven't got enough time for that today.
No, we haven't got enough time because we've got to go. But normally, at the end of a budget discussion, we'll go winners and losers. It's hard this time, isn't it, really? Because we're all just muddling through the best we can.
Oh, no, I think we're all winners from this budget, because we all need to, make sure that those 5 million people, almost 5 million people on furlough, get back into work. And today's budget was a great way of making sure that can happen, the most part into 2021.
Right. Okay. Well, good to talk to you, John. And look, next time you post something on LinkedIn. So John, by the way, it always posts very positive, glowing outlooks on LinkedIn. And I'm normally the first one there going in the comment section going, oh, I don't know about that. I'm not so sure. So I promise I'll